Part 1: Wall Street's Most Trusted Man. When Bernard Madoff walked into a room, the people did not see a criminal. They saw Wall Street royalty. Madoff had spent decades building the most trusted name in American finance. In 1960, he started Bernard L. Madoff Investment Securities, building what seemed like a legitimate market-making firm. He was one of the companies that bought and sold stock on behalf of big financial players. Madoff was not operating from a seedy office run out of a shady website. His firm occupied multiple floors of the Lipstick Building in Midtown Manhattan, a landmark in the city's skyline. His customers included banks, wealthy individuals, charities, universities, pension funds, and international investment houses. Madoff had been chairman of Nasdaq. He knew technology, regulators, and attended ritzy charity galas. His firm was professional, solid, and embedded in the U.S. financial establishment. It was this reputation that allowed his deception to succeed. Madoff's private investment business was said to be elite. He did not go looking for customers. In fact, people needed a personal referral to get an account. This had the powerful psychological effect that the investment didn't need the customer. The customer, instead, needed access to the investment. Many affluent clients saw an account with Madoff as a status symbol. If you got in, you were part of an exclusive investment club. Madoff promised something that all investors craved and few achieved: reliable returns. His accounts reported positive gains year after year. When the market rallied, Madoff booked profits. When the market faltered, he still usually reported a gain or a relatively small loss. The gains were never big enough to be completely unbelievable, but they were steady. That steady predictability was far more enticing than the potential of an occasional large payout. Madoff's investors saw him as someone with a genius strategy for guarding against volatile market conditions. He appeared to be conservative and disciplined, immune to the wild ride of financial markets, even as the world outside his window spun in chaos. And perhaps the biggest warning sign lay in exactly what Madoff's customers lauded the most. Real markets are chaotic. Madoff's results were so incredibly smooth. His investors believed they were watching a financial was eliminating risk, when in fact they were watching a man making risk disappear. Part 2: The Machine That Printed Profits. Madoff told investors that he used a strategy known as split-strike conversion. The explanation sounded technical enough to discourage ordinary clients from asking too many questions. According to the story, Madoff purchased shares from major companies represented in the Standard & Poor's 100 index. He then used options contracts to limit losses when the market declined. The strategy supposedly allowed him to capture gains while protecting investor capital. But the trades did not exist. When customers sent money to Madoff's investment advisory business, their funds were deposited into a bank account. The money was not consistently invested in the stocks and options displayed on their statements. Instead, it was used to pay customers who requested withdrawals, finance parts of the business, and maintain the appearance that the investment operation was real. This was a Ponzi scheme. Old investors were paid with money arriving from new investors. As long as more money entered than left, the illusion could continue. Madoff's employees created account statements showing trades that had never happened. They used historical market information to select prices that would produce the returns Madoff wanted investors to see. The system could manufacture the past after the past was already known. If Madoff wanted an account to earn approximately 1% that month, employees could choose fictitious buying and selling dates that created the required result. If the performance appeared too perfect, Madoff could even add a small fake loss to make the account look more realistic. Millions of pages of confirmations and statements were produced. Every document strengthened the illusion. Customers opened envelopes and saw familiar company names, precise prices, transaction dates, option positions, and growing balances. The numbers appeared official, but they were financial theater. No investment strategy had created the reported profits. No secret algorithm had defeated the market. The extraordinary trading operation existed primarily on paper and inside computer systems programmed to support the lie. The scheme became more dangerous as it grew. Every fictional profit increased the amount Madoff supposedly owed his customers. If someone invested $10 million and received statements claiming the account had grown to $20 million, Madoff now needed to maintain the illusion of a $20 million account. But the second $10 million had never been earned. It was a fictional obligation created by a printer. By November 2008, Madoff's customer statements showed approximately $64.8 billion in total balances. That number later became the famous $65 billion figure associated with the scandal. But there was never $65 billion sitting inside a hidden vault. Much of it represented decades of imaginary profits. The real money was far smaller. The lie had become larger than the cash that had ever entered the building. Madoff was not managing the world's most successful investment fund. He was managing the world's most expensive collection of fake receipts. Part 3: The Man Who Did the Math. Not everyone was so sure. In the late 1990s, financial analyst Harry Markopolos was hired by a rival company to take a close look at Bernie Madoff. They wanted to know how he had been so consistent and how he had been making money that was nearly risk-free. Markopolos reviewed the investment process and immediately saw the red flags. They were: Madoff claimed to be dealing with an enormous amount of trades and options that should have overwhelmed the market size, and he should not have had nearly risk-free profits. The structure was murky and confusing, and there seemed to be a lack of segregation between advisory functions. This was enough for Markopolos to conclude: either Madoff was bribing SEC regulators with insider trading and the inside information was provided to him on his own trades, or he was lying and not making those trades at all. Either way, I do not believe he is honest in his claims. He felt it was extremely unlikely Madoff was engaging in the illegal practice of insider trading, but it seemed overwhelmingly probable that he was running a Ponzi scheme of unprecedented proportions. Over the next decade, Markopolos sent warnings to the Securities and Exchange Commission. His most damning message, entitled "The World's Largest Hedge Fund is a Fraud," pointed out over 30 warning signs that supported his assertion that Madoff's published returns seemed mathematically impossible. The report detailed how the underlying trading couldn't be happening and provided evidence of an outright hoax. But somehow the SEC never uncovered the fraud. They had a lot of the information in hand over the years: reports from sources in the market, an in-depth investigation with credible sources. They even had conversations with Madoff himself and looked at many of his company's books. However, they never did some of the basic things that would have been easy to do to uncover the truth. For example, they didn't follow up on or check whether or not the trades actually happened with stock exchanges. They also didn't verify whether or not the assets Madoff claimed to have were truly in accounts held by independent institutions. Instead, time and again the agency came to rely on the information provided by Madoff himself and the reputation he had cultivated within the financial community over decades. I learned to dread meetings with Madoff's staff at the company because he would lie to them too. They were smart and able men. They would tell him, "Sir, that trades can't happen and the regulators are checking that, the markets would reflect those movements, how do we make these profits?" And he'd laugh and then tell them, "Don't worry, it's all just a magic show." A lot of these employees knew what Madoff was doing, but no one ever had the bravery to blow the whistle for fear of the backlash they would suffer from their employer and the damage to their careers. The agents investigating the fraud were either not intelligent enough or had not been sufficiently trained on the particular products Madoff was trading to grasp the intricacies of the underlying fraud. They were unable to follow the trails provided by savvy industry professionals. Every SEC case involving securities requires expertise, proper expertise. It's difficult to pin down one single reason that the SEC missed so many red flags for so long, but in the end, they failed on planning, they failed on execution, and they failed on leadership and supervision. This wasn't a failure because no one recognized Madoff's signs and told the proper authorities. People recognized them and told them. They warned them. But somehow, despite the numerous red flags and tips from experienced market players, no one ever connected the dots. This isn't a story about Bernie Madoff creating an impenetrable fraud. It's about trust triumphing over fact, faith triumphing over fraud, and the willful failure to connect the dots. Madoff knew if he stayed under investigation and never was indicted that his operation was somehow legitimate, and it only enhanced his reputation when he avoided trouble for many years. Investors looked at the fact that they had been looked at and yet never put away, and instead of suspicion, viewed it as a sign of legitimacy. They saw that to get out of being charged and being caught by regulators was actually proof of that the company was not operating any scams, and that this whole scam was on the up and up. The watchdog barked, but to get rid of him he gave him a dog biscuit. And he walked away as before. Part 4, The Day the Money Ran Out. A Ponzi scheme can survive bad investments, for the simple reason that it is not reliant on them. It can't survive large-scale withdrawals. In 2008, the global financial system was entering the most dangerous crisis for decades. Banks collapsed, stock markets cratered, credit dried up. Investors got spooked, and they wanted their cash back. For Madoff, it was game over. His customers were being told their statements showed money that could be withdrawn, a notion that they relied on when they called in to demand billions of dollars. But there was no such money. One of the accounts used for the investment advisory operation had approximately $295 million on December 1st. But the demand to take out cash that day was $1.45 billion. The financial machine had arrived at the familiar end game of every Ponzi scheme. More money was going out than coming in. Madoff scrabbled around for new funds, but the global financial world was under strain. The previously eager customers were now demanding money back. There was no fresh supply of cash large enough to bail him out. On December 10th, Madoff confessed to his sons, Mark and Andrew. He had the added torture of a final admission of a total lie: the investment advisory business is a fraud. They contacted attorneys who alerted the authorities. The following morning, FBI agents turned up at his Manhattan apartment. When they ask if there is an innocent explanation for this behavior, Madoff apparently replies that there is not. It was over. In a flash, the dollar figures printed on thousands of account statements became worthless pieces of paper. Families thought wealthy became destitute. Retirees saw the plans for the rest of their lives collapse. Charities and foundations shut down. Some of Madoff's victims had gambled and lost everything they had. Others had actually withdrawn more money than they'd put in, without realizing that this was the proceeds of the fraud they were party to. The consequences ricocheted across networks of friendship, trust, and community. Friends had persuaded friends, financial advisors recommended Madoff to their clients, even some wealthy and respectable families and institutions followed where trusted others had gone. He had weaponized personal relationships. Ironically, the very sense of exclusivity which had made him attractive also precluded scrutiny. Nobody wanted to miss out or admit that they didn't fully understand the strategy. Most importantly, perhaps, nobody could bring themselves to believe that a figure who had enjoyed access to the great and good of Wall Street had been perpetrating one colossal deceit. It's brutally simple. For years the customers got a statement. It showed how much money they owned. But the statement itself was the product. Part 5, The Price of Trust. March 12, 2009, Bernard Madoff pleaded guilty to 11 federal charges. Securities fraud, investment advisor fraud, mail fraud, wire fraud, money laundering, false statements, perjury, false filings, theft from an employee benefit plan. There was no trial. Madoff had admitted his investment advisory business had been a fraudulent enterprise. June 29, 2009, Madoff was sentenced to 150 years in a federal prison, the maximum possible sentence. He died in prison in 2021. But the legal work, the financial work, continued long after that. Investigators chased down assets. Trustees pursued those institutions and individuals who had been compensated with money flowing from the scheme. Funds were recouped from banks, feeder funds, the first investors, members of Madoff's extensive family network. The chase turned out to be one of the largest, most complex financial investigations in history. By the close of 2025, the trustee responsible for the liquidation had recovered or agreed to recover approximately $14.8 billion. Separately, more than $4.3 billion was disbursed by the U.S. Department of Justice's Madoff Victim Fund to over 40,000 victims globally, making recovery for those victims approach 94% of their calculated loss from all sources combined. It was an astonishing recovery. But some things money couldn't fix. Some victims died without seeing a dime. Some families fractured. Some charities shuttered. Retirements were wiped out. Some who'd referred their own friends and relatives, victims themselves, wrestled with guilt over having done so. The scandal changed the global understanding of financial fraud. Madoff didn't dupe people with overt signs of crime. He didn't lure them by behaving like an obvious fraudster. He gained their confidence by presenting an image of utter respectability. He didn't promise outsized gains overnight. He offered stability and discretion. He didn't stand outside the system. He positioned himself at its heart. The most terrifying element of the Madoff story isn't just that a single person could construct such a colossal edifice of non-existent wealth. It is the magnitude of the system failures that surrounded him. Professional money managers couldn't check trades. Feeder funds took in cash without asking too many questions. Auditors overlooked red flags. Regulators received direct tips and failed to act. Everyone saw only a piece of the machinery. Almost no one stopped to ask if the machine was even real. Madoff understood something crucial about trusting numbers. They aren't just believed because they're correct. They are believed based on who's delivering them. A credible name made a seemingly impossible return acceptable. An opulent office made clandestine practices look refined. Exclusivity made doubt feel like ignorance. For decades, Bernie Madoff didn't beat the stock market. He conquered human susceptibility to trusting a name others trusted. That $65 billion empire never really existed. But the faith it inspired was substantial. And once it collapsed, there was only blankness left, a bank account, forged statements, and a lie big enough to swallow Wall Street whole. This is the Noir ledger. Every fortune leaves a paper trail. And sometimes the paper is the fortune itself.